Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about Matterport. So, Matterport is a company that I've been quite bearish on for some time, and I mean, it's kind of interesting to see how the sentiment has changed so dramatically in the last several weeks. So, ultimately, I still believe that paying 22 times this year's revenues for Matterport is still overvalued. So, I'm going to go through that. I'm going to talk about some of the highlights here, particularly talking about its guidance and how that's going to play out. Talk about its profitability profile, and yeah, and talk about its valuation. So, I'm going to just jump right in. So, here's the thing, right? So in the last several weeks, we've seen the share price meaningfully sell off more than, let's say, 40% in a few weeks. It's really just kind of gone like that. And here's the thing. So in a previous article back in October, I said that the Matterport's share price has been volatile of late. So I kind of got in just before the peak. And I said that, however, that hasn't stopped it from jumping 82% in the past 3 months alone. And that's an astonishing feat in and of itself, made more notable that so many high growth names have already fallen out of favor with investors. And it's the underlying fundamentals of Matterport are actually moving in the opposite direction. And the share price is soaring higher and higher, even though the fundamentals appear to be deteriorating. And then I went on to complete the article and saying that I know from experience that as long as the share price is moving up and to the right, nobody asks difficult questions from their investment. But also know that sentiment can be notoriously fickle and here one day and gone the next. Now, here's the thing. Since I wrote that article, the share price is down 42%. And that's the thing with investing. So you kind of want to be a buy and hold investor, and you have to be willing to embrace a downturn. You can't just be a buy and hold investor as long as the share price is going up, because that's not good investment discipline. That's just gambling. And if you don't want to be a buy and hold investor, you need to be a bit sensitive with the valuation that the person ends up paying. Because if you're deploying your hard-earned capital, you want to make sure that you're getting good return on the investment. And you can't control the company's prospects, but what you can control is the price that you're willing to say, okay, I'm going to invest or I'm not going to invest. Now, here's the thing. So this is the guidance that they put out from 2019 to 2025 estimates. They're going to be growing at 59% compounded. Okay, that was the guidance. They came out and was like, oh my God, this business is just going to kill everything. And when it turns out, it's a bit kind of too futuristic, that guidance, because for Q3 21, the revenues were only up 10% year over year. I mean, we're talking like really small numbers here. And the guidance for the remainder of the year at the high end points to approximately 110 million. So that's a meaningful drop from the 123 million that they had pointed out that they were originally going to grow. So they're going to grow slower than the first part of this graph. So it really brings into question how 2022 is going to unfold. Now, it's kind of interesting because when I said all this, basically, that I was kind of saying right now, a few weeks ago, when the share price was meaningfully higher, it's interesting to see people's feedback to that. And that's how it is in investing, as long as the share price is going up, everyone's kind of like, just set and forget the share price. But, when things kind of fall 40% in a few weeks, everyone's like, okay, let's start asking some tough questions here. And my contention was then, and my contention is now, that the business, it's just really very capital intensive, okay? And if previously investors have been willing to look beyond that, here's some context, right? So if you look at the balance sheet, it has no debt. That's correct, right? So it has approximately 330 million of cash and cash equivalents, but it also has 335 million of earnout liabilities. And you can see here the balance sheet. And what it means in practice is that for investors, you know, look, consider this, right? So for them to grow their revenues by approximately 84 million in the 9 months of 2021, they had to burn through 26 million of free cash flow. So if you look at the capitalization of intangibles and the purchase of PP&E, so yeah, that comes to 26 million of free cash flow used up. So that means that for them to grow their revenues, they have to have a negative 31% free cash flow margin. It's really, it's not a great investment if you get $1 in revenue, but you having to burn through that dollar and then some to grow that revenue. it doesn't make a lot of sense. That's a really poor return on investment. It's a very capital intensive business, irrespective of whatever the rhetoric is about how they're gonna disrupt like architecture and all that. I mean, it's just yeah. Anyway, it's one of those things, but it's made more difficult because the company provides very little visibility into how 22 is going to unfold. Now, here's some context, right? So right now, investors are paying 22 times this year's revenues as an estimate. Okay, this is the consensus estimate, but keep in mind that nearly all of the analysts in the last several weeks have downwards revised the estimates for 2022. But even in that context, the stock is priced at 22 times this year's revenues. Now, you could either pay 22 times for revenues for Matterport, or you could pay 26 times for Unity. Now, I don't have any position in Unity, but Unity is often recognized as a leader in 3D technology, and they're already reaching approximately more than 3 billion monthly users, mostly in gaming, but they're also doing a lot of stuff with architecture and engineering. So, I mean, you have a leader which you can have some question marks about, if they're going to sustain that strong revenue growth rate of plus 35% that they're guiding for. Um, you can have some kind of questions around that, but they're really, really well exposed to this space, and you pay 26 times revenues for Unity, or you can pay 22 times for Matterport when it's really unprofitable. Its revenue growth rates all over the place. In Q1 they were up more than 100% year over year. So they went from 100% year over year to Q3 at just 10%. So it kind of brings up questions of what 22 is going to look like. Um, so I mean, and I get that it's kind of, you feel probably that it's unfair for me to pick on Matterport because Matterport is down when everything else in tech is down, but a lot of things are down, and it's your responsibility to kind of dig through that and find out and sift through and find out there are some good investments to be made in tech, and I believe that I'm investing in some of those, um, and I just can't see the reason to pay such a high premium for Matterport. So if you want to find out the names of the companies that I'm investing in, don't forget to check our marketplace. The name's right there, Deep Value Returns. You can see what other people have said, read through the reviews, and I help you think about investing in high quality, actionable investment stocks. Okay, thanks so much for listening. Bye bye.